Hello guys, I'm CA Chetan Kansara and I'm a qualified chartered accountant and a BCom graduate. I am located in Mumbai, India. I have an experience of more than 25 years in the area of finance subject. Currently I teach CA students, ACCA, CFA and CS students. Guys, today we are going to discuss a topic called as cost of capital. In cost of capital, specifically in this video, we'll be covering cost of equity. Now, before we start with cost of equity, let us understand the concept of cost of capital. We will start with an example. Suppose, for example, you need $10 lakh for your business. Okay, now what are the possible sources of finance for you as a student? The possible sources of finance, say for example, you can take a bank loan, say at 10% bank loan, $6 lakhs, right? You're getting a $6 lakh loan at 10%. Suppose you are getting $2 lakh loan from a friend. You are getting $2 lakh loan from your dad, papa, right? Total $10 lakh you are getting in this particular fashion. Okay, for example, you'll be wondering, sir, my dad won't charge me interest. Actually, this is the opportunity cost. Your dad says, if I keep this money in the bank as it is, then also I will be earning interest. I will be getting interest of 4%. But if that money I'm giving it to you, you should at least earn 4% from this business, whatever you're doing, right? So every fund has cost. No fund is free of cost, remember. Okay, so this is the pattern of your 10 lakh rupees. You are getting 10 lakhs in this fashion. Now on this $6 lakh, you will be paying 10% interest, 60,000. On this 2 lakhs, you will be paying 7% to your friend, 14,000. On this $2 lakh, 4%, that comes to 8,000. Total is 82,000. So this 10 lakhs is costing you $82,000. So on 10 lakhs, 82,000, that comes to 8.2%. What is this 8.2%? It is the cost of capital for you. It is your weighted average cost of capital. This 10 lakhs is the capital. This is the capital you are investing. You are employing in your business. So what is WACC? It is weighted average cost of capital. This 10 lakhs is costing you 8.2%. The point is, sir, why do we need to calculate this 8.2%? You are going to invest this 10 lakhs somewhere, some business, right? So from that business, you should get minimum 8.2%. This is the cost on your capital employed, which you are going to compare with return on your capital employed. The return should be more than 8.2%. So this gives you an idea that minimum I need 8.2% return from the capital which I am investing in the business. Correct? Similarly, like your cost, we are going to talk about company. You get funds from different sources. Company is getting funds from different sources. Equity. Company can raise equity by issuing shares, equity shares, ordinary shares. Company can raise funds by issuing preference shares. Company can raise funds by debt. Debt can be loans. Debt can be debentures, bonds. So all these funds which the company gets have some cost. No fund is without cost. Every fund is costing something to the company. Now in this chapter, what we are trying to do is we are trying to find out the cost of equity, which is denoted as KE. K stands for cost. In the Latin language, K stands for cost. Cost of preference shares. We will be trying to calculate cost of debt, and after calculating these three costs, we will be calculating the overall cost of the company, which we can denote as KO, or we can call it as WACC, that is weighted average cost of capital. Like we calculated 8.2% for your funds. Okay, these are the different sources of funds for you. Similarly, these are different sources of funds for the company. So overall cost for the company is this, which we compare with the return on capital employed. Okay, when I compare return on capital employed with the cost on capital employed, the difference is called as economic value added, which we are not covering in this topic. Okay, now in this chapter, this particular topic, we are interested only in calculating the cost, and to be very specific, in this video we are going to cover cost of equity. Okay, this concept will help you in exams. Let us proceed. Cost of equity. Now this cost of equity depends on what? Whether cost of equity, KE, depends on whether there is a growth in the company, whether there is growth in the company or no growth in the company. Cost of equity calculation, we have two concepts. Here in ACCA we have two concepts. One is dividend valuation model, we called as DVM, and the other is CAPM, capital asset pricing model. Currently, first we are concentrating on dividend valuation model. Dividend valuation model, right? Acha. Now it depends on whether company has growth. Growth means what? Growth in profits. So hence there will be a growth in dividend. And if there is no growth, if there is no growth, if there is a growth, right? So no growth means constant dividend, and if there is a growth, it will increase by at a particular rate, right? Now what is the formula? The formula for calculating here KE, cost of equity, will be D1 upon P0. Correct? Over here the formula will be D1 upon P0 into 100 plus the growth rate. Sir, what is D1? D1 is the expected dividend, the dividend which is expected to be earned in the coming year, the immediate dividend which company is planning to pay in the coming year, that is called D1, expected dividend. And what is P0? P0 is actually the current market price of the share. Current market price of the share. Okay, here also the concept remains the same in this formula. Okay. Now what is G? G is the growth rate, and what is growth rate we are going to discuss. Now let us understand the formula. Pay attention. D1 upon P0 into 100. Now actually the formula is P0 equal to D1 upon KE. Okay, this is the original formula, and from this we derived this formula. Over here, what is the original formula? It is like this: P0 equal to D1 upon KE minus G, and from this formula we derived this. Now what is the logic of this particular formula? Now obviously we are not supposed to prove this formula in exams, but for our understanding we will discuss these two for our understanding, right? Now what is the logic of this formula? Remember, this is the value of a share. This formula helps you to estimate the share price. We are trying to estimate the share price. What should be the share price? I said should be. What is the actual price? That you will get it from the market. Okay, so now P0 equal to D1 upon Q. What is the D1 upon Q? What is the logic of this formula? Remember, value of any share, in fact value of any asset, is a present value of all future cash flow which you expect to earn from that asset. Suppose for example, I want to value your business. I want to take over your business. So what should be the value of your business? We will try to find out what cash flow will be generated from your business, and I'll be discounting the cash flows at a particular rate. We have done this in investment appraisal topic. So we will be discounting at a particular rate. Which rate? The rate which I want to earn, minimum I expect from the business, from your business. So suppose your business have a life of 5 years. All 5 years cash flows we will estimate, and I will discount at the rate which I want, which I expect. And suppose that comes to 50 lakhs. 50 lakhs. Say for example 50 lakh rupees aata hai. So this 50 lakh rupees I will be offering for your business. Now suppose you are saying, sir, I expect 60 lakhs for my business. I will not give you 60 lakhs because for me the worth of your business is 50 lakhs. So I can pay you maximum 50 lakhs. So what is 50 lakhs? The intrinsic value of your business. I repeat, intrinsic value of the business. Similarly, we are trying to find out the intrinsic value of a share. But the problem is what, for a business, the life is say 5 years, 7 years, 10 years. But for a share, the life is perpetual. So what is the present value? How can we calculate present value? Now this is something extra we are doing. How do we calculate the present value of something which is perpetual? So see, anything which is perpetual, the formula is A upon I. What is A? A is the annuity, the constant amount. And what is I? I is the rate at which we discount. I is the rate which we expect to earn. Okay, now obviously you are not supposed to remember this. You are not supposed to produce this explanation, this particular working in exam. It is only for our understanding. Okay, now see, pay attention. Annuity, constant amounts. Say for example, for a share, there is no growth and the dividend is 4 rupees, 4 rupees, 4 rupees, 4 rupees till perpetuity. Because equity shares doesn't have a constant fixed life. It is perpetual. So A upon 1 plus I, this is the present value of the first year dividend. This is the present value of the second year dividend. Third year dividend, present value. Fourth year dividend, present value. So like this you are going to get present value. And this will be perpetual. This will be perpetual. So how should we find out the sum of perpetual annuities? For your business, as I said, there were 5 years. So for all the 5 years, we calculate the present value and we get the worth of your business. But here, 5 years, no, infinite life. So this becomes an infinite GP series, geometric progression series. And what is the sum of infinite GP series? It is A upon 1 minus R, the formula. So what is A? A is the first term. This is the first term. This is an infinite GP series. This is the first term. And what is R? R is a common ratio. Common ratio means second term divided by first, third term divided by second. We are not going in that much detail over here. This is just to prove that this formula has some logic. It is a present value of all future cash flows. I am not discussing this in detail, not required. Okay, but when we do AFM, there we go in detail, this concept. Okay, but here in FM not required. We are not supposed to produce this in exam. Okay, so what is the first term? This is the first term. And what is the common ratio? Second term divided by first, third term divided by second. See this, second term divided by first. It comes to 1 upon 1 plus I. Third term divided by second term, 1 upon 1 plus I. So I just substitute over here A upon 1 minus R. A upon, what is A? A is the first term. R is a common ratio. Common ratio we get it from here. Okay, and then we solve this. This will get cut. It is A upon IC. So what is P0? Price of a share today is the present value of all future dividends from that share. I repeat, price of a share today should be the present value of all future dividend from that share. Discounted at what? Discounted at the required rate of the investor, shareholder. Okay, so this is A upon I. So say 4 rupees dividend and 10% is expected return by equity shareholder, then 40 rupees should be the price of the share. So what is the formula now? P0, price of the share today will be D1, expected dividend. Dividend, this is 4 rupees. The first one will be 4 rupees. D1, D2, D3, D4, D5 and so on. Okay, so it will be d1 upon k. So we get p0 equal to d1 upon k. From here we get the formula ke equal to d1 upon p0. Ke equal to d1 upon p0. So now comes to this formula. See, this is the formula. d1 upon p0 is the share price. Okay. Now let us take one or two examples on this and then we go for the second one. Okay, let us take an example from the Kaplan book. This one. Chalo, first one. A company has paid, test your understanding. First one, dividend valuation model with no growth. Just an example. A company has paid a dividend of 30 cents for many years. The company expects to continue paying dividend at this level in future. The current company share is $1.5. What is the cost of equity? Tell me, is there any growth? No. Company is giving constant dividend of 30 cents. Right? So what will be the formula? I'm just solving over here only. So KE equal to D1 upon P0. How much is D1? Dividend is how much? 30 cents, 0.3. And P0 is the price of the share, $1.5. So what is the answer? Solve this. So if we solve this, we get an answer of 0.3 divided by 1.5. That comes to 20%. Okay, so 20% is your cost of equity. Okay, so here we don't have growth rate. Now, suppose there is a growth rate, then what is the formula? If there is a growth rate, then the formula will be little different. Let us take this one. Chalo, pay attention. If the growth rate is there, actually this is a formula, but this formula is derived from this logic. Logic of this formula. Present value of perpetual growing annuity. There is a growth. Suppose for example, dividend is $4 for the first year. Expected dividend for 4 rupees. This dividend is increasing every year by 10%, 10%, 10%, 10%. Say $4 plus 10%, $4.4 plus 10%, $4.84 and so on. So how are you going to write this? D1 into bracket 1 plus G, D1 into bracket 1 plus G the square, then cube and so on. Right? So present value of this, present value I'm discounting at what rate? KE. What is KE? We can call it as RE or KE. This is the required rate of return by the shareholder, by the equity shareholders, right? Okay, so this will be D1 upon 1 plus K. This will be D1 bracket 1 plus G upon 1 plus KE the square, because the second year, third year, fourth year and so on. Again, this is the first term. Again, and what is the common ratio? Second term divided by first, third term divided by second, right? So same way we can continue. This is the first term. See the common ratio. Second term divided by first term, we divided, we got this. So I'm not going in that much detail. We'll just wrap it off. This is the first term, this is a common ratio. So A upon 1 minus R. A is the first term, R is a common ratio. Okay, if you solve this, this will get cut. You will get D1 upon, this will get cancelled, KE upon GC. And from this I am getting this formula. Okay, KE minus G, I bring it over here, P0 I bring it down, and then this comes the formula. So in short, what is this formula? What is this formula? This is actually coming from this. What is this P0? Price of a share today should be equal to present value of all growing dividend, all growing future dividend. Right? If there is a growth rate, this is the formula. If there is no growth rate, this is the formula. Okay, we are trying to find out the cost of equity. As I said, cost of equity, you have two calculation. One is dividend valuation model, other is CAPM, which we'll do later. DVM, dividend valuation model, we have two formulas, one without growth and one with growth. Okay, now this is with growth. Let us take an example with growth. uh, from your Kaplan book. Test your understanding. Second question. P company has just paid a dividend of 10 cents. Just paid, so already paid. Now when I'm using this formula, remember this formula says D1. So what is D1? D1 is the expected dividend which is to be paid in the coming year. And what this question says, it says has just paid. Company has paid the dividend. So this is not D1, this is actually D0. Okay, the dividend which is already paid, we call it as D0. Okay, has just paid a dividend of 10 cents. Shareholders expect dividend to grow at 7% per year. P company's current share price is $2.05. Okay, it has just paid a dividend of 10 cents. So what we want? Last dividend was 10 cents. So if I am writing the formula KE equal to D0, I have to write D1. So I need to add growth rate upon over here KE equal D1 upon this is P0, okay, plus the growth rate. See the formula? See this formula? So what is D1? Expected dividend. How should I get expected dividend? The last dividend was 10 cents and there is a growth of 7%. So it will be 10 plus 7%. So 10.7 will be the expected dividend. Upon P0, what is the share price? $2.05 into 100 plus the growth rate. And what is the growth rate? Growth rate is 7%. So let us solve this part. So that comes to 10.7 divided by 2.05. Okay, I repeat 10.7. 10 cents. I am so sorry. It is 10. So 0.1 it is. 0.1 plus 7%. So 0.107. It is 10 cents. So 0.1 plus 7% divide by 2.05 plus 7%. So that comes to wait, 107 divided by 2.05. Okay, so that is 12.23. Okay, so 12.23 or it is 22. 12.22% is your answer. Okay, now let's go to the next question. One more question we'll take, this one. Company has recently paid a dividend of $0.23 per share. Recently, so this is what? D0. Okay, the current share price is $3.45. If the dividend is expected to grow at an annual rate of 3%, then what is your answer? Company has recently paid a dividend. So 0.23 is D0. So my formula will be like this. D1. D1 will be what? D0 0.23 plus the growth rate of 3% divided by your P0 into 100 plus the growth rate. Growth rate is 3%, right? So solve this. What is the answer? 0.23 plus 3% divided by 3.45. Okay, plus 3. So that is 9.87 approx. 9.87% is the approximate answer for this particular calculation. Right? So I hope this part is clear. Now, one care you have to take when the dividend is already paid, that is D0. But sometimes what happens, company has declared a dividend. Okay, and company has declared a dividend. So what happens? The share price goes up. As soon as the company is going to declare or already has declared, what happens is the share price is expected to go up. Why? Because suppose if the share dividend is expected to be paid, if I am a shareholder, I will try to buy the share. Let us understand this. Say for example today, okay, and today market price of this share is say $50, and this company is expected to pay a dividend of say $5. Okay, today dividend has been say declared. Dividend is declared. As soon as the dividend is declared, the share price is expected to go up. Why? Because everyone will be expecting to earn, will expect to earn this dividend. Now for example, say the payment date is, say today is 16th of April, suppose, and dividend is expected to be paid on 30th of April. This is the payment date. Okay, this is the payment date. And before that there is one more date which is called as the record date. Say 28th of April is the record date. Is a record date. Now what is the record date? This is a date on which your name should be there in the records of the company. In simple words, you have to buy the share on or before 28th of April, depending on the country. Actually depends on the settlement period. Okay, for example in India you have to buy the share one day before. So if you buy the share on 27th, your date, your record, your name in the company's record will be on 28th. So it depends on country to country, correct? But on 28th of April, whoever name is there in the records of the company will get the dividend. Okay, so what happens, during this period the share price goes up. Why? Suppose I don't have the share of this company, I will try to buy the share at 50 rupees. I'll get the dividend of 5 rupees over here. So the share will be costing me 45 rupees. Yes or no? So everyone will try to do this. I will buy the share at 50 and I'll get 5 rupees dividend over here. Then for 50 I'm paying 5, I will get it back. So 45 will be my cost. So everyone will try to do this. So that will increase the share price. Demand for the share price will go up. Share will go up, right? But here the share price is expected to become 55. 5 rupees, 50 rupees plus 5 rupees dividend or $5 dividend. Suppose if you are a shareholder, you have the share of this company. Will you sell the share now? No. You will say, I will wait. Why I should sell the share now? I will wait and I will get the dividend of $5 or 5 rupees. Yes or no? So the seller won't sell and the buyer wants to buy. So buying pressure will increase and the share price will go up. So during this period, the share price is expected to go up to $55. Before this, the share price is X, that is X dividend, excluding dividend. Here there is no impact of dividend. Here also there is no impact of dividend. So throughout the year, almost the share price is X dividend. Only for a short period, from the date of declaration maybe till the date of record. In that particular period, the share price goes up. That price is called cum dividend. So whenever they give you cum dividend price, remember it is the price of the share including dividend. Now for our calculation, when we calculate the cost of equity, what price we should take? We should take X dividend because that is a regular price. Cum dividend is only for a short period. Okay, so here it explains everything. Cum dividend share price minus dividend due will be X dividend share price, and we should consider X dividend price for our calculation. Okay, so whatever I've explained is everything is over here. We just take an example. Take this example. X dividend share price. The current share price is 140 cents and the dividend is 8, is due to be paid shortly. is due to be paid shortly. That means this price is including dividend is due to be paid shortly. So dividend must have been declared. It is not yet paid. 140 cents is the value of a share, current share, which include the effect of dividend. So 140 minus 8, so 132 cents will be the ex dividend price. Okay. Let us take one more example. D company is about to pay dividend of 15 cents. About to pay. The shareholder expect dividend to grow at 6%. D Limited current share price is $1.25. Okay, is about to pay a dividend of 15 cents. So first of all, I'll just explain, we can solve it later. From 1.25, I'm going to deduct 15 cents as a dividend, as a to get the ex dividend price. So this is come dividend price. It includes the effect of dividend because dividend is about to pay, just about to pay. So $1.25 minus 15 cents, 0.15. So you will get what? You will get the ex dividend price, which you use it for the calculation of K. Okay, I hope it is very clear about this. Now let us take an example on calculation of growth rate. How do we calculate the growth rate? What is the logic of calculating the growth rate? What is the logic of calculating the growth rate? What is our formula when you have the growth rate? The formula is K equal to D1 upon P0 into 100 plus the growth rate. This is our formula, correct? Now, how do we calculate growth rate? It is B into R. So, what is B? B is retention and R is return on equity. This particular formula is given by a person known as Gordon. So, we call it as Gordon's model also. Okay, so it is retention into return on equity. Let us take one example. This is retention into return on equity. What is retention? Retention means what? It is 1 minus payout. Payout is the proportion of profit which is paid out as dividend. Correct? You know what is payout. We have done the dividend decision chapter. But those who have not done, let me explain. Suppose the earning per share of the company is say 10 rupees. And out of that, 40% is paid out as dividend. So out of 10, 4 rupees is paid out. So 40% is payout, 60% is retention. Okay, so growth rate is retention into return on equity. What is the formula for return on equity? It is net profit after tax minus preference dividend if any upon equity. So profit available for equity shareholders will be in the numerator upon equity. Okay, this is a formula for return on equity. Let us take one example to calculate the growth rate. So this formula, calculate growth rate if ROE, return on equity, is 20%. When I say return on equity 20% means what? Company earns 20% on equity shareholders' money. When I say return on equity is 20%, it means the company is earning 20% on equity shareholders' fund. Right? Payout ratio is 30% and the value per share is 300. To understand the growth rate, what we do is we calculate earning per share and dividend per share for 3 years for better understanding. Okay, I repeat, the value of the share is 300 and return on equity is 20%. Now see, pay attention. What is the value per share? 300. In year 1, I am taking 3 years, year 1, year 2, year 3 to understand the concept better. In year 1, company is earning 20%, ROE is 20%. So on equity shareholders' money, company is earning 20%. So it is 20% of 300, 60. In year 1, company is earning 60 per share on 300 rupees. Out of that, what is the payout ratio? DPS is dividend per share. Payout ratio is 30%. I said payout ratio is 30%. So 30% of 60. So 18 is the dividend per share. So out of 60, 18 is paid out. So what is the retention? 42. So in year 2, company is going to earn on 300 plus 42, 342. Again in year 2. Now in year 2, company is going to again earn 20%, but this time 20% will be on 342. So on 342, company is earning 20%. That comes to 68.4. Correct? And then 30% of 68.4 is this 20.52. 20.52 is the dividend for the second year. Now in the third year, what will happen? 342 plus this is the earning minus this is the dividend paid. This is the amount on which company is going to earn in the third year. On this figure, 20%. That comes to 77.976. Okay. Out of this, 30% is paid out as dividend. So it is this figure. So it will continue. Now the point is, what is the earning per share in year 160? It becomes 68.4 in the second year. There is an increase of 14%. You can check. There's an increase of 14%. Right. Pay attention. Calculate 68.4 minus 60 divided by 60 into 100. That comes to 14%. And similarly from second year to third year, see the earning. It is increasing by 14%. It is increasing by 14%. So every year earning per share is increasing by 14%, 14%, 14%, 14%, 40. That is a growth rate. Growth means what? Growth in earnings, growth in profits. Okay. Now similarly, if you see the dividend per share, see the dividend per share, it is 18 to 20.52. So there is an increase of how much? There is an increase of how much? It is 20.52 minus 18 divided by 18 into 100. So there is an increase of 14%. Same way over here, there is an increase of 14%. So every year dividend per share is also increasing by 14%, 14%, 14%, 14%. But we have an assumption. This is the growth rate. I hope you understood. 14%, 14%, 14%. Every year earning is increasing by 14%. Every year dividend per share is increasing by 14%. But we assume that payout ratio will remain constant. We assume that payout ratio will remain constant. 30%, 30%, 30%, 30% in perpetuity. If it is 30%, say next year 32, then third year 29, then this won't be 14, 14, 14, 14. Remember. So this formula, this concept assumes that payout ratio will remain constant and ROE, return on equity, will also remain constant. It will be 20%, 20%, 20%, 20%, 20%, 20%, and so on. It will remain constant. Okay, so 20% if it is 22 in the second year, if it is 19 in the third year, this won't be 14, 14, 14. Remember, growth rate is perpetual. For that, ROE and payout ratio will always be perpetual. That will also be perpetual. Okay, now we have a shortcut of calculating this. We got 14% increase, right? What is the formula? Growth rate is B into R, retention into return on equity. What is the retention over here in our example? 30% is payout, so 70% is retention. What is return on equity? 20%. That comes to 14% directly. So this shortcut we are going to use for calculating the growth rate. Okay, this Gordon's model assumes that ROE and payout ratio will remain constant in perpetuity. I hope it's fine. Now, let us take an example on calculation of growth rate. Acha, one more thing, let me explain. See, there are three earning per share figures: 60, 68.4, 77.976. Right? We can do like this also. Suppose you are given three dividend figures, 1, 2, 3. I can use this formula, amount equal to principal 1 plus R raised to n. So what I can do is, I can write 60 rupees as the initial dividend, or earning, we can say earning per share. And after 3 years it is 77.976. 1 plus R raised to 3. Raised to 3. But 1, 2, 3. When there are 3 figures, I will write raised to 2. Okay. Remember, when there are 3 dividend per share or earning per share figures, I will write raised to 2 because there is a growth 2 times. So I will write 2. And if you solve this, you just solve this, you will get 14%. Okay, so instead of 3 dividend figures or earning per share figures, if you have suppose 5, I will write raised to 4. 7, I will write raised to 6, and so on. Let us take an example from your Kaplan book. This is the formula which I was just explaining you. Okay, we no need to do this. We can write like this: amount equal to principal 1 plus r raised to. We can use this. Okay, let us see. A company currently pays a dividend of 32 cents. 5 years ago, the dividend was 20. Okay, now what is the annual growth rate? You can use financial calculator. Okay, and on your financial calculator, what you write is n. N is what? 5 years. Take the financial calculator and solve. N is 5 years, and present value, dividend increases from 20 cents to 32.32 cents. So PV, you take negative 20. Take negative 20. Okay, then future value you will take 32 positive. PMT, payment, you will take nil because there is no payment between the years. Compute IY. Compute IY. So see what you are getting. You write 5n, then 20 is your PV, but don't forget to put a negative sign, correct? 32 is your FV. PMT, you keep it 0. Compute IY, that comes to 9.87% approx. Okay, so 9.87% you're getting approximately growth rate. Okay, so in other words, 20 cents plus 9.87% plus 9.87% plus 9.87%, 5 times you will get 32. 20 plus 9.87 plus 9.87% plus 9. You add up 5 times, you will get 32. Okay, let us take one more example to understand the growth. Company has paid dividend per share over the last 5 years. 1, 2, 3, 4, 5 dividends. So I'm going to write raised to 4. Okay, so if you solve this, it will be like this: amount equal to principal 1 plus r raised to n. So that will be 10, the starting point, and the 5th year figure is 14.5. 1 plus r raised to n raised to 4. So this becomes actually very simple. You just have to write, right? Come on. So for the company paid dividend per share over the last 5 years, you can solve this and you can get the answer. Okay, like this you have to solve. Okay, annual historic growth rate. Chalo, let us solve this. 14.5 so that is 1.45, and then you take root twice, so you're getting 1 point. If you solve this and then minus 1, so this is approximately 1.01 you're getting. Okay, 1 plus r. See, it will be like that. I'll just explain. This is 1.45, 1 plus r raised to 4, so take root twice. So you are getting 1 plus r equal to 1.097. So we'll just make it 1.01. Okay, so r equal to the 1.09. So that will be 1 actually, right? So this will be 10%. That will be 10%. Okay, 1.097 you are getting, right? So 0.97 approx. So that approximately 10% is the answer. This is how you calculate the growth rate. Okay, now this is a retention example which we have discussed. Okay, now just to sum up, end up, what are the advantages and disadvantages of dividend valuation model, which we have done. Uh, it sounds theoretical because we assume return on equity constant, we assume payout ratio constant, so it is little theoretical. Okay, we there are some assumptions made, so it becomes theoretical. Whatever we calculate, we sit and calculate, the same price will be prevailing in the market. Little weird, right? But that's the reason we call it as theoretical. But it is most commonly, right, most commonly understood, easily understood. So this is an advantage. Theoretical, it is an advantage as well as a disadvantage. The useful objective comparison for different dividend paying companies. If the companies are not paying dividend, I cannot use this formula, I cannot use this concept. But those companies which are paying dividend, for that it is this is the best. If there are two companies paying dividend, I want to compare the intrinsic value of the share. Good model. Useful for companies that pay consistent dividend. Companies paying dividend, then formula is useful. Disadvantage is the input data may be inaccurate. Current market price fluctuation. Too much of, if the shares are very fluctuating shares, the prices are going up and down very rapidly, the formula doesn't work. It won't give an accurate answer. Future dividend pattern assumptions. We have to assume that there will be a growth rate of 10%, 10%, 10% perpetual growth. This is may not be possible every time, right? The not useful for companies that don't pay dividend. The growth in earning is ignored. The growth in earning is ignored. We assume the dividend payout. Growth in earning, here we are considering the earnings, but the impact is on dividend. They are saying dividend increases by 10%, 10%, but that is indirectly due to earning only. So when I say growth in earning is ignored, this is not exactly correct according to me. There is an earning in growth. There is growth related to earning, because this particular sentence doesn't make that much of sense. Not useful for companies that don't pay. That's okay. Assumption of a perfect market may not hold true. We have to assume that the market is perfect. Okay, market is perfect and everyone is going to buy shares when the price go down, price will go up, that time they sell. Is a perfect market, everyone behaves normally. This is an assumption. Less applicable for larger shareholders whose influence the dividend paid. Less applicable to larger shareholders who can influence the dividend paid. So this is a disadvantage, because many it less applicable to larger shareholders who can influence the dividend paid. So suppose if dividend is not paid, the shareholders may sell off the shares. If the dividend is excessive paid, then people will buy the shares. So it is less applicable for larger shareholders who can influence the dividend. So this formula won't work over there, because they can impact the buying selling decision. They can impact the share price accordingly. Okay, so this is all about the dividend valuation model. Guys, we are going to cover CAPM in the next video. Okay, again I am CA Kansara, Chetan Kansara. I teach FM at ACCA, at CFA, at CA and CS. If you want to buy this video, you can visit to the website Let's Learn India. Okay, and here you can apply for, you can buy the shares. So guys, I hope you liked the video and it helped. Do subscribe to my channel to get the regular updates and regular videos. To purchase my lectures, you can visit the website Let's Learn, or you can call up at 844-844-8919. Thank you.